Hi, this is Matthew Cratter from Trader University, and today I want to talk about 5 signs of a coming bear market. Now, if you're worried about this market or you just want to follow along with what I'm doing, be sure to hit that subscribe button. Now, the first sign of a coming bear market is basically all over the internet today, the yield curve inverting. I'll explain to you briefly what this means. On Bloomberg, here I'm just looking at government rates, U.S. Treasury yields on Bloomberg. And what you want to look at is you can look at the whole curve. But in particular, you want to look at the 2-year note, the U.S. Treasury 2-year note, and the 10-year note. We can see the 2-year note, the yield is currently about 1.57%. The 10-year note, the yield is about 1.58%. Earlier this morning, the 10-year note yield got below the 2-year note yield. Right now, it's basically flat. In the past, when this happens, this has been a big indicator of recessions. Every recession, the last bunch of recessions have been predicted by this. I'm trying to think of a case where the yield curve inverted and we did not get a recession. I don't think we've had that in modern times, or at least in the 20 years. So this is definitely something to be concerned about. Now, the second sign would be market leaders breaking down. So we have all the FANG stocks, Amazon breaking down here. Really hasn't been behaving very well since earnings. Facebook breaking down in spite of all the news surrounding its new cryptocurrency, etc. Google has just been really straight down since earnings. And not only are we seeing these market leaders breaking down, but we're seeing a lot of the momentum names that we've been making a lot of money on in the last few years breaking down. Planet Fitness is a big one, PLNT, Smartsheet, IPO from last year that's just been behaving really well, but it's breaking down as we speak. Stocks like Twilio, which we've explored in the past, now trading below its 50-day moving average. And you can see that we're getting a breakdown both in market leaders and in momentum stocks. And one of the reasons they're called market leaders is because they are almost like canaries in the coal mine. They lead on the upside, but they also lead on the downside. Now, in addition to this, and as part of the flattening yield curve or the inverted yield curve, bank stocks are just getting totally hammered today. Wells Fargo down 4%. You can see the banks have been not doing well for a while. They tend not to do well in an environment where the yield curve is flat or inverted. Also, Bank of America, you can see just totally off a cliff, down 5%. And even bigger investment banks, Goldman Sachs, just behaving very poorly. And these are indicators that it's a difficult environment, not just for banks to make money, but for momentum names, etc. And the last sign of a coming bear market is really an acceleration to the downside of some of the most heavily shorted names. iRobot is one that's just been really going down over the last 2 earnings. This is a heavily shorted stock, down 3% in the day, hitting new lows here, new 52-week lows. That's IRBT. This is another momentum name that was doing well on the upside, has broken down, and is now a market leader to the downside, heavily shorted. And finally, our old friend Tesla. Tesla looks like it's resuming its downward spiral, trading below the 50-day moving average. And this is another indicator because in a bear market environment, companies like iRobot and especially companies like Tesla just will not be able to survive because they are constantly needing to raise new capital. Now, on the bright side of things, 2 of the stocks we talked about a couple days ago are holding quite well. There are some internet names, some tech names that are holding well, or software names. Q2 Holdings, QTWO, looks like it's being accumulated here. Even on this market weakness, it's holding pretty well. Down about 2%, but still holding very close to the highs. And also I would say solar stocks still looking good. SolarEdge off a little bit, off about 1.8%, but again looks like it's being accumulated on every dip. And of course the gold stocks as well, gold and the gold stocks. You can see gold here hitting new 52-week, actually really new multi-year highs. So those are some names from the upside. We want to definitely be careful though, and we want to keep an eye on the S&P 500 and the NASDAQ 100, these indices. If we zoom in here, you can see we had been trading above the 50-day moving average on the SPY, the S&P 500. You can see we played around a little bit at the 50-day moving average. We fell below it, We had a brief recovery where it was able to close one day above the 50-day moving average, and then a pretty sharp rejection off the 50-day moving average. Now the next line in the sand is the 200-day moving average for this. And what we've really seen before all bear markets is a crossover where this 50-day moving average line crosses below the 200-day moving average line. That's what we'll be looking for in the weeks and months ahead. But I'm just making this video to show you these signs that I'm seeing, sort of canaries in the coal mine. We haven't really rolled over yet. We're still kind of in a trading range from the past, the past year and a half. We're still kind of stuck in this trading range, unable to get above 3,000, trading, testing the 280 levels or the 2,800 levels. And so I would really, urge all of you, this is not a reason to panic, but you should really know what you're invested in, what your holding period is, and you should definitely have a rainy day fund as well. All of these signs are quite recessionary, especially the yield curve inverting, and these things tend to be the canaries in the coal mine. So make sure you're prepared. It's been a pretty good prosperous 10 years. We're definitely overdue for a bear market, and the 10-year note, the bonds are really signaling. You can see the 10-year note here just going off a cliff. The yield, it was as high as 3%, now down to 1.6%. There's some disconnect here between the bond market and the stock market still being close to highs here. I think the bond market wins. I think the recession is on the horizon. So just be careful out there, know what you're invested in, and stay safe. Hit that subscribe button if you haven't done already. If you have any questions about this video, just leave it in the comments below. Thanks a lot for listening, and I'll see you in the next video.